Hi, my name is Nicolas. I'm the interim CEO of CGrowthCapital. For those of you that don't know me through some of my other companies, let me introduce myself. So I am a serial entrepreneur. I have been since a very young age. I came out of school or through school into after school years playing semi-pro sport, which why I mention this because it's relevant to this particular company. And pretty much went into business at a very young age, from the age of 21, and have built and sold numerous businesses along the journey in multiple different sectors. I perhaps have a slightly different management style to the average OTC company. And I know there were a few tweets and people asking about, how I can be involved with many different things. I'll summarize that firstly before I get into the business. My strategy is always very, very simple. I can identify opportunities, or I like to think it's a strength that I can identify opportunities. And I'd like to think that I'm pretty good at identifying the right jockeys to ride those opportunities. So really my role, on a macro level is to identify the opportunities, find the vehicles to put the opportunities in, bed them down with the right management team, and what I call the jockey, i.e. the CEO, who will ultimately run the business and add value to the business on a daily basis, while I'm able to add value into the group and into the companies by continuing to source and find and negotiate other deals and strategically add value, whether it would be with new products or new management or new services, cross-pollination between other businesses, other contacts, other networks. Typically I only get involved with sectors and industries and businesses where I know I can add a hell of a lot of value for the shareholders and for clients, customers, staff, suppliers, basically the whole value chain. And I would like to think that I have done that pretty well in the past, and would like to think I'm going to continue to do it well in the future. Now, that being said, my strategy always is to build long-term, sustainable, and most important, scalable companies. And I know sometimes that gets a little bit misconstrued in the OTC, which is very much viewed as a short-term, market. We're not into, and I'm not interested in short-term pump and dump, get into a business, run it for a year, get out of it. That's just not the way we do it. I don't see us, any of the businesses I'm involved with, staying in the OTC space for very long. But the OTC is a phenomenal launch pad, and it's an excellent playground to get started on a business, to get some volume into the stock, to get a shareholder following, to raise initial smaller values of capital. I say smaller values, sort of sub $20 million at a time, and to get used to the public market space. But ultimately, the real businesses need to be up in the major markets, in the big boards, Nasdaqs, New Yorks, Hong Kong. I mentioned Hong Kong because there's a lot of shift towards the east currently. So that's sort of really my let's say my skill set and my strategy in a nutshell. So focusing on growth capital, really I see a huge opportunity for this business, which is why I took it over. And with a complete reorganization, a complete restructure in terms of the management and the way forward and the business strategy and where it's trying to go as a company. And I'll talk a little bit more about that kind of as this presentation goes on. So to continue on about the actual company, CGrowthCapital, where we've got to, and how we're going forward, and sort of the ideas behind that. I took over the company because I saw a massive opportunity for a company that was undervalued, and that usually creates a lot of opportunity really to add some shareholder value, both in the short and medium term. I have an interest in companies which are undervalued, have a relatively clean structure, and maybe crazily enough have the right amount of outstanding shares that there can actually be some volume created. The OTC investor is typically a more short-term trader rather than a long-term investor, as you would get on the big boards. And what I mean by that is, as we see in some of the stocks that have really tight floats, which is obviously the ultimate company. However, on the OTC, that doesn't particularly work very well because it can't get any liquidity into the stock. It can't get any trading. The OTC traders don't pay high cents and dollars for stock. That just doesn't happen in the majority of circumstances. Therefore, there isn't the volume. And if there isn't the volume, there isn't the interest, they don't get enough shareholders trying to buy, the price doesn't move, you can't raise capital. So although, in a big board or a normal company, a very, very tight low float makes, is the ultimate. And the OTC, in my belief, maybe my opinion, but in my belief, it doesn't work that well. We sort of need the right volume of shares outstanding that you can actually create the liquidity as the shareholders want to buy their stock available, the orders can get filled, it creates movement, it creates liquidity, which makes it available to raise capital much easier, but also it creates a good trading opportunity for the investor base. However, that said, it can obviously get too top heavy, and I felt Capital Growth or Growth Capital was sort of just the right level, maybe a little bit on the heavy side, but the right level. But kind of the way the deal's been structured, there isn't really many more shares to go out, or any more shares really to go out. So there's a tiny, which I'll talk about a little bit later, there's a tiny little bit of debt left, but the majority was spun out, which I'll talk about. So firstly, I took it over because I like the structure, I like the way it was. I thought it was really, really undervalued. I like taking a company from pink, and then we can climb it up, get it fully reporting. Once it's fully reporting, then go to QB, and then look to take it up to a big board, which would be the journey. Now, that said, it's really, really important, and I know again this upsets the traders sometimes, that takes time. And I know we've got a strong saying in the eyeless business, to trust the process, and it really is about a process. If you take it over, jump in, all guns blazing, rush a couple of deals, eventually the house of cards falls over, which is not what anyone wants. And I know in the short term, the shareholders are happy and, sending you roses and bottles of champagne. However, longer term, they're all going to come running after us with guns. I'm joking, but you know what I mean. It's really important that we build a solid foundation, solid structures from the ground up. And that does mean that it takes a little bit of time, especially on a company like Growth Capital, that we've got to reorganize, bring in the new management who are experienced in the sector. We've got to get a whole load of fundamentals done. And then the two deals are lined up. They're basically ready to close. I'd like to say within days, but it's definitely within weeks. And then after that, it should be close execution of a lot more deals and a lot more really interesting, exciting news. I appreciate this, interim period has been a little bit dull and a little bit quiet, but we've been working behind the scenes to get all the things ready. The deal ended up closing a little bit quicker than we had anticipated. Hence why we, were caught a little bit with our pants down that the website wasn't done, the social medias were not all in place, but that'll be in place, I'm hoping, by the end of January. The new exciting website, the shareholder engagement off the back of the website with the data room and all the fundamentals that we need to engage with, with you, the shareholders, and be able to update you on a daily and weekly basis of what's really going on. And again, improved social media, rebranding. So that's all going on rapidly behind the scenes, and I'm hoping by the end of January that'll all be in place, which again should be a good news feed for the shareholders as all that stuff sort of starts to materialize, during which time I hope that the first one, possibly two deals are completed. Now, I'll talk about those deals a little bit later in this presentation. But ultimately, what we really need to do is create these foundations, get the company nice and solid, get the stock trading nicely, which really is about getting shareholder buy-in, getting eyes on our stock, getting people to know about the business, what it's up to, what it's doing, get people to understand the deals that are coming in or have and / are coming in. And then after that point, we're then able to execute a lot quicker on everything. And then we'll move pretty quickly into the fully reporting stage and onwards. So, I'm very excited about the business. I'll talk about the sector in a while. And we're busy in the process now of bringing the management in, which, as I mentioned at the end of last year, I think on a tweet or on a PR, and I can assure you 99% of the time, what I say is going to happen is going to happen. It may not happen in the time that everybody expects, but it is going to happen, and at some point it will happen. On the odd occasion it doesn't. It is usually because of macro circumstances, i.e. something's changed in the market, something has changed in whatever. It might be a deal, there might have been a better opportunity, there might whatever. It is life. Things don't always go exactly to plan. But as the shareholders, I'm sure you'll get to know me over time. What I say is going to materialize. Even if it does take a little bit longer than everyone expects. So, I'll repeat myself as I've said on all the other companies I'm involved with. Trust the process. we're going as fast as we can. We've got to get the right management in place. We've got to build solid story and a solid business and solid fundamentals, solid revenue, and grow the business up. So just, I think, a couple more things before I get into the nitty gritty. Just talking about the macroeconomics of or conditions of the world at the moment. I think there's obviously a recession looming. In some ways, that's obviously really, really bad news. But obviously, out of a recession, it's a cleaning up exercise, but usually there's a lot of really great opportunities born. It makes people really look in the mirror and reorganize themselves. It makes businesses get leaner and reorganize themselves, the ones that are strong enough. But ultimately, it creates a huge amount of opportunity for businesses to get consolidated, to merge, to get taken over. Businesses struggle to raise capital, so the ones that do have capital or can raise capital are able to really maximize on the opportunities through these recessions. So, while we all have to take our belts up a notch and be prepared for a little bit of a cold winter, it doesn't mean all doom and gloom. It doesn't mean the opportunities aren't there. And I spoke a little bit earlier about the fundamentals of a business. I think if we look back over the last year, the number of uplistings to the major boards, to the big boards, the major boards, was really, really limited. And as we speak right now, it's still pretty limited. I think NASDAQ, don't quote me on the terminology, but NASDAQ more or less had a moratorium on uplists. And I think that was fundamentally because so many uplists over the last, let's say, 18, 24 months didn't go well because people didn't have their fundamentals in place. And I spoke a little bit earlier about the OTC, having a slightly different way of operating. The typical OTC CEO, OTC company, I think, and I'm well aware of it, the OTC, to operate the company, a company as you would, on a small micro cap market, with a lot more freedom and a lot more ways, easier ways to do business, is very, very different to the big boards. So you might be a big fish in a small pond in the OTC. And, this is part of why things have taken a little longer than we would have liked in some of my other companies. We never want to be a small fish in a massive pond, because we're going to get eaten alive when we go up to the big boards. So it's that borderline between becoming a big fish in a small pond and when are you ready, both structurally, financially, revenue-wise, balance sheet-wise, management-wise, reporting-wise, to go up. So I think through these macroeconomic conditions which are changing, I think it's going to see a good opportunity for some opportunities of mergers, clean out, companies that are going to disappear, other ones are going to arise. And we're definitely going to use this opportunity to maximize on that. The company's in pretty good shape. It's got good funding offered and currently in place, and offered and arranged. So we have no shortage of funding for deal execution. Now we just need to basically get, as I say, fundamentals and then execute on all the deals and continue to put the strategy together. But what we continue to see, and I've spoken about this, I think maybe earlier last year or the year before, what we are continuing to see around the world is that the boomer generation are starting to exit their businesses and wanting to pass the businesses down to, the younger generations, who a lot of the kids, are not, I say kids, young millennials, are not really interested in running the family businesses like it used to be 2 or 3 generations ago. So they're looking to offload. We've got this gap in the market where, there is that opportunity to swallow up companies that have got long historic standing brands, maybe need a slight rethink on their strategy or their marketing approach, maybe need a little bit more technology brought into their business, but ultimately have that route to market and that distribution, which is what we'll be looking to capitalize on in the medium term. While in the short term, we're really focused on getting these first 2 deals bedded down, which are both technology in their own space, which I'll talk about in a little while. So I just thought I'd share some of my thought process on this macroeconomic conditions that we're facing at the moment. So to talk about the actual, let's say, deal structure in the company, I basically acquired the control block for the old operating company spinning out, with majority of the debts and assets and licenses that were attached to it. And I tell you the logic behind that from a corporate point of view. I didn't believe that particular strategy was right. I didn't believe we would yield any better returns from those assets in the long term, keeping them in the company. We didn't want to hold the debt in the company either. There's a small amount of debt that has remained, But in terms of the actual operating company, I didn't feel, or say we, the controlling parties, didn't feel that it was, likely to add any shareholder value in the short, medium term. And to get to the long term, it would have needed significant, in our opinion, it would have needed significant capital to actually materialize anything that would really be meaningful. And again, refer back to the early part of this conversation. We're building long-term proper businesses that can go up to NASDAQ or New York or a major board. Not a business that can announce a news of some new license and get some short-term pump and raise a stock price for today, and 6 months later, nothing's materialized, nothing's happened, and the share price goes back again. That doesn't benefit anyone. The guys that got in early get up to the top, sell at the top, and everybody else loses, which is not the way I like to do business at all. We're trying to build this step-by-step fundamental business. So that was basically the logic behind it. So the assets spun out with it. They went private with the debts and the management, and basically we were left with a clean vehicle, and that's what we'll continue to develop. Now, that doesn't mean, please don't get me wrong, that doesn't mean that it was a poor business at all. I just didn't feel it really was beneficial to the current shareholder base and the current structure of that particular business, being Growth Capital. I didn't feel that in a year's time, you would meet me at a shareholders meeting and say, that was great strategy, well done. So, I believe, the strategy that we've taken is the right one. And I hope to prove that right going forward. Now, we're going to focus on effectively sports, technology, disruptive technology, and lifestyle brands and lifestyle technology. Now, it's a pretty broad topic. I don't actually like the topic, to be frank. I wouldn't call it that sort of sector, but that is the way it's categorized, let's say on the business listings. Now, some of those sectors are relatively new, but what I would urge and encourage you guys to research and think about and, talk amongst yourselves about is, when people hear the word sports, sports technology, they immediately think physical sports, a football player, a basketball player, maybe a basketball, shoes, baseball bat, whatever. The sports tech, the whole disruption around sports tech is a lot more. And there's a lot of, let's say, gray edges around that topic, such as things like Fitbit, for example. That business came out of nowhere, got to multi-billion-dollar valuations. And technically, that could be just a total tech stock. It could be a wearable tech stock. It could also be a sports disruptive tech. It's in that gray space, and we intend to play in that great space. So going beyond sports, the terminology sports, we're not necessarily talking about sitting at a football game. There's a lot that goes around that, from wearable tech, blockchain stuff, IP products, food and beverage, and player and fan engagement at games, whether that would be sports betting, whether that would be serving drinks, in the stadiums, whether that's the way things are advertised and marketed in the sports space, or events, because hence the lifestyle brand as well. It could be more than just sports. It could be lifestyle events, concerts, etc. And that space is growing phenomenally. It could be the way physical sports or lifestyle events or any of that type of content is delivered, the delivery systems, the streaming systems. The world is just craving content. I'm sure most of you have watched Netflix in the past, and how many programs you've watched on there in a different language with subtitles, because there's just not enough content in this world. So there's, again, another major opportunity around that. There's big data from sport. That's not only about sports physical players. It's everything around the events. It's around people behavior. It's data around people that register for events. There's a whole massive area around the topics that we're talking about. So, I very much don't want you to just immediately get turned off by the topic of sports, sports technology, and think that we're just selling, I don't know, gym gear or basketballs, or we're going to have retail stores. It's totally not what this business is about. And as I said earlier in this meeting, I came from a semi-pro sports background, let's say semi-pro into pro, and I could have taken it further. Just however, with I needed to decide on the way forward of my career and what I felt was going to be best for me in the short term and for my family in the long term, and hence basically getting out of sport and focusing on business. And I love business. Business is what drives me on a daily basis. I do the business I do because I love it. I love the adrenaline of deals. I love finding the deals. I love the people. I love networking. I love putting the people together. And ultimately, I love winning. I love nothing more than winning. In fact, let me rephrase that. I hate losing. Losing is not a word I take lightly. It's not a word I like. It's not a word I'm comfortable with. I cannot stand losing. So bear that in mind, when supporting my companies. So the sports disruptive tech is very much a broad sector, very much a broad, brush approach. We have to create a little bit like we did with the ILUS model. We have to create the routes to market. We have to create the following in terms of the actual customer base, so the brands start to, pick up some leverage. And as I mentioned before, me coming from a sports background, I've seen how the sports I were involved with, those days until where they are now, they might as well be different sports. The actual sports themselves are modernizing. They're changing the format. Those of you who follow, for example, follow the Formula One, I don't know, let's say 5-10 years ago for sure, but maybe even as soon as 5 years ago, it was almost a dead sport. The numbers weren't growing. The following wasn't growing. It was basically going more or less nowhere. It was a sport that our parents used to say, please keep quiet, I'm trying to watch the race. That's now changed just by the way they've engaged with the users, by the content, by the sort of Drive to Survive network, Netflix series that they produced. There's now, as you know, there's races in America. I think there's Austin, Miami. It's going to be Vegas next year. I'm just using that as an example. So you can imagine all the opportunities just around that one particular sport that didn't exist as short as a year or 2 or 5 years ago. And that's everything involved with those particular, and that's happened in numerous sports. So if we look, I'm not sure if those of you are familiar with cricket, which is a European sport, and South African and Australian sport. I believe it's now in America coming quite aggressively, and that particular sport, again, was very similar. Most of the games were 5 days. It's a real drawn out process. It was losing viewership, again, because the millennial, Gen X, Gen Y type, Gen Z, whatever you want to call it, are much more on demand type of people. They don't want to sit for 5 days and watch a sports game like our parents did. So that sport, a lot of the cricket now has gone from being 5 days to being 2 hours or 3 hours. Totally different. A lot more opportunities, a lot more entertainment. It's now called the IPL. For those of you that are not familiar with cricket, I'd urge you to go and have a look at it and just have a look at the revenue around that. Cricket was a dead donkey's game. It really was. Again, not even 7 years ago. They're now paying millions and millions for players. The streaming rights went for hundreds of millions this year. It's just, again, imagine the opportunities around that, not just about cricket balls or t-shirts. And that's going to happen now in every sport. So we're looking quite closely at boxing, some combat sports. If you look at the life cycle of UFC, for example, as MMA, Muay Thai, that's all just ballooning phenomenally. It's just absolutely going mental. And the sports sector in general is relatively informal and relatively unstructured. And where there's informality and where there's lack of structure in a market, and typically what I've always found, I'm quite disruptive in the way I like to do things, typically where anything has been dominated by, please don't take offense to this, people older than me, by dinosaurs in a sector that have done things for the last 20 years. Their parents did it the same way. Why should they change? Where you've got that type of culture, there's an opportunity for disruption. There's an opportunity to turn it upside down, rip it apart, do it in a new way, and that just changes everything. And that's sort of the space that we want to be in. And so going back to what I said a little bit earlier, there will be some, let's say, less exciting businesses that we acquire. And again, you have to trust the process, that there's a strategy behind them. We have no intention of becoming a pure retailer. That is not our intention. But some of retail products which we do acquire offer a particular purpose, which we will make you aware of at the time. And the technology businesses which we acquire will have a massive overlap and a massive draw to a bigger play. As I say, we're trying to build a $100 million revenue business in a relatively short period of time, which we've done on 2 of the other businesses I've involved. We've done it within 12 months, and I would expect that we can do it in this business in a similar period. And then we become more of a serious contender to go to a major board. So watch the wires, watch the news feeds when the acquisitions come out, because in these early stages, it's really important that you understand the strategy of the business and buy into the strategy of what we're trying to do. I'll try and put out another podcast as soon as I can around the acquisitions as they materialize, which should be, the first one should be relatively soonish, to try and explain to you how the strategy and kind of how those pieces fit together. So thanks everyone for listening. I'll close up here, just wrapping up. some of the things you've got to look forward to in the coming weeks, let's say 2 to 6 weeks or 1 to 6 weeks. Basically, new board, or the first 2 acquisitions to be announced. They are as good as completed. We're really just working through some of the, let's say, after deal stuff that needs to be bedded down, such as banking, IP protection, all that type of stuff, so we don't fall on our face after closing. So you can expect those 2 deals to flow in the short term. The board recruitment or board announcement. So there's new people coming to the board with experience in the industry and in the space, of which 2 of those are coming from the acquisitions we are acquiring, hence the delay in announcing them. So that'll be coming. The new website will be launched with some new branding. The website will be highly engaging with a data room for be able to provide you, a good amount of due diligence on a regular updated basis. That's just sort of some of the immediate highlights for you to look forward to. We will be filing either a Form 10 or an S1 over the next month to 2 months, really to start to get us to be fully reporting, which is very, very important for the going forward of the business and the scaling of the business. And we're looking at a whole bunch of other opportunities as well, which more and more information will come out sort of as time develops. So I'd like to thank you for being a past, current, future shareholder, whichever category you may fall in. I hope you find this journey engaging and rewarding over the next coming weeks and months and years. And you can usually reach me over LinkedIn or social media or whatever. Obviously, we have a whole lot of activities to do in the business on a daily basis, so you may not always get a response, but generally we are listening. And we generally try to come back and field, all the generic questions that come, or any specific questions where there's a common flavor. So although you may not get a response instantly, you can expect information on, if it's a regular question or a regular theme, where those questions will come, those answers will come out within a PR or shareholder letter or social media or whatever. The social media, you can expect it to start to become way more active. It's been a little bit quiet while we've been getting down, bedding down some of these fundamentals, and through the Christmas New Year period. As I've said before, we're not a pump type of stock. We're trying to build a proper business, a fundamentally stable and growing and scalable business. And therefore, we didn't want to come across too pumpy over Christmas, where there wasn't really a lot happening from a shareholder point of view. Although behind the scenes, there's a lot of value being added on a daily basis. So again, I'd like to leave it there, and thank you for everything, and thank you for your support, and I hope to work with you and meet you at shareholder meetings in the future. Thank you so much, everybody.